everyone, and welcome to Schwab's 2026 Market Outlook. I'm Marley Caden, and I'm thrilled to be here for what has become one of the most important conversations of the year for investors. If 2025 taught us anything, it's that markets are remarkably resilient, even in the face of extraordinary uncertainty. We've seen swings in inflation expectations, shifting global trade policies, tightening financial conditions, and geopolitical tensions that continue to reshape how investors think about risk, all while equity markets continue to move to new all-time highs. Tonight, I'll be joined by Schwab's team of market experts. Schwab Asset Management CEO and CIO Omar Aguilar will join me shortly to take a look at the state of global investing. Liz Ann Saunders will be here to break down the domestic economic outlook and what's in store for equities. Michelle Gibley will weigh in on what to watch in global markets. Kathy Jones and Colin Martin will cover what's in store for fixed income in 2026. And Joe Mazzola will join me here in Chicago to set up what traders can expect next year. Then we'll wrap up with a lightning round featuring our panel of experts answering your questions. Joining us now is Omar Aguilar, CEO and CIO of Schwab Asset Management. Omar, thank you for being with us. Let's start big picture here. We had a volatile but a resilient 2025. What is your overall outlook for 2026?
Yes, thanks for having me. We are fairly constructive on what 2026 may look like. I think when you look at any outlook, you always try to balance what are the tailwinds and what are the headwinds. And on balance, there seem to be more tailwinds than headwinds. When you actually think, the areas of, easing monetary policy with the Federal Reserve expected to continue its easing cycle, when you see a very accommodating fiscal policy that has taken into effect, when you think about the increases in productivity, the high levels of capital expenditures on artificial intelligence, when you see a rebound and a very resilient, consumer and investor confidence is starting to just, look better, a little more stability. Overall, it looks like the tailwinds for a potential constructed moderate growth in the U.S. economy will continue into 2026. Of course, there's always headwinds and there's always risk that people need to consider. You have geopolitical risk. We still have trade policy risk. I think the biggest risk to the overall economic picture ends up being the dynamics between an inflation that, while it's stable, obviously still has the risk that they potentially could go. And this concept of what we call the K-shape, consumer, where the lower end of the consumer, it's probably strained and continues to have potential concerns that may impact, the credit market.
And we continue to have this discussion surrounding this bifurcated or K-shaped economy that we're in. How would you describe the state of the U.S. consumer today, and what does that mean for growth going into next year?
Well, when you think about the top part of the K, so those high income earners, they've been, clearly, been enjoying the wealth effect that they have come with the market over the several years. Strong balance sheets continue to support the economy, very, sustainable and repeatable consumption that continues to drive GDP growth. And in general way, that wealth effect has overshadowed any potential inflation concerns that have come their way. On the other hand, you actually have the lower end of the consumer, that end part of the consumer that is more sensitive to inflation changes, to oil prices, to changes in any parts of food prices that may actually go up. And also at the same time, it's at the mercy of the potential labor market dynamics. So, the bigger part of what you see over there that may impact the overall picture of the economic and the financial, outlook for 2026 is that to the extent that credit component starts to deteriorate further and we're starting to see more defaults, credit card issues that may affect financial institutions and things that started to go into less liquidity, that actually could potentially put a strain on the outlook.
And we have seen the credit markets be incredibly active. You were just focused there on the consumer, but we've seen a great deal of activity around AI financing for data infrastructure and this build out that we're seeing in this AI boom. Do you think that trend remains healthy, or does this introduce new risks?
This is a new part of the credit market that I think we will be all watching in 2026, and certainly will play a role in just looking at how these different transactions will work. Because, just this year, we reached close to $100 billion in financing for AI infrastructure and in the whole ecosystem of AI, not just data warehousing, but overall utilities, overall power, and overall, the public and the private markets are actually now in the center of financing that extreme, levels of capital expenditures, specifically for these hyperscalers. So when you actually look at how that works and how these, dynamics will go, there are certain companies that have never gone into the debt market to actually increase their capex. Is going to be new for them, and therefore, the dynamics on how they create that financing and how they monitor and the quality of those, debt creations is going to be something that will play a role going into next year.
And while we're talking about AI investment has become a major force, not just in the economy here in America, but in the global economy on the whole. How big of a driver do you think that AI and infrastructure spending will be for markets in 2026?
We have discussed this in many forums that the AI, structure and cycle is in the early innings. It's just the beginning of going from, the source, which started with the hyperscalers, to now going to different parts of the economy and different parts of the corporate structure, where you see companies in the majority of industries starting to make that adoption of AI and investing in AI. So the capital expenditures that have been, for the most part, concentrated in those hyperscalers, mega technology companies, is starting to now just to go down to areas where the majority of companies, when they report earnings, they actually now have an item that actually has to do with capital expenditures for AI adoption. I think the biggest, trade-offs in this area is, to what extent the cycle starts to hit into the profitability of those capital expenditures. And I think that sort of friction between the size of the capital expenditures with the profitability of AI is certainly something that is going to come to a head, probably in the next 18 months or so.
Certainly. And in terms of the equities, you mentioned some of the mega cap tech names there. We've seen a very narrow market led by those big names in tech. Do you expect that leadership to broaden next year, or will it stay the same? And if you do expect it to broaden, where might we see that?
Yeah, I think a bigger part of this and the concentration of markets, and clearly the leadership that we have seen, those, mega cap, technology names, we expect that these will basically continue to probably in the first part of the year, but we expect that these broaden and starts going into other areas. And I think that the two things that will probably allow for that is, on one hand, is that easing of monetary cycle. The easing of monetary conditions usually tends to give that tailwind to more cyclical sectors and companies that tend to be possibly affected by, easing monetary conditions. So that will help small caps, that will help financials, that will help. And to a certain extent, we're seeing some portions of that through the last, several months of 2025. So we expect that to be a little more broad. And at the same time, the earnings and the stability that we see for those mega caps will continue, into the most part of 26, but it's not going to be as concentrated as it was in 2025. And we expect that sort of market, to be a little more broad in terms of the participation and contribution to the results.
And Omar, with everything we just talked about, and for individual investors who are looking to try to stay disciplined in this environment that has some tailwinds, but a lot of headline risks, from geopolitics to upcoming election uncertainty, what would your biggest piece of advice be for them heading into 2026?
Yeah, we believe that the whole concept of behavioral economics and behavioral finance is clearly something that we keep reminder investors that is critical as they continue to go in through next year. I think we just talk about the state of the economy. We think about friction between the labor market and the inflation component. We think about high rises of volatility. We see headline risk. We see policy risk. There's a lot of things that will come, to the headlines that I think the biggest part of the biggest risk is these behavioral aspects on how investors take that information and make decisions on their strategy. So our best advice has always been to stay invested. There is very little probability that anybody can actually be successful at market timing. So staying invested is something that helps in the long run. Stay disciplined, which basically means define your rules on what are you going to do when things go positive or negative, and maintain that structure that you have as discipline, no matter in what market conditions. Stay diversified. diversified. And I think this is a big component that has transpired over the last 2 years, where these what we call endowment effects of home bias effects, will prevent investors to actually diversify a portfolio, as they're not willing to sell their winners. They actually concerned about that the trend is going to never going to stop. So the stay diversified is a big component to that, and of course, a big part, create a systematic approach that will allow us to minimize those facts. So stay systematic, stay disciplined, stay diversified, and stay invested are the 4 things that we tend to remind investors that they should continue to achieve the long-term goals.
Some great insight there. Thank you so much to Omar Aguilar, CEO and CIO at Schwab Asset Management. Coming up, Liz Ann Saunders will join us to examine what's in store for U.S. stocks and domestic economic conditions. Will the mega-cap tech names continue to drive overall market gains? That's next on Schwab Market Outlook 2026. Welcome back to Schwab's Market Outlook 2026. I'm Marley Caden. Let's cover what's in store for U.S. economic outlook and the equity markets with Liz Ann Saunders, Chief Investment Strategist at Schwab Center for Financial Research. Liz Ann, thanks for being with us tonight. Markets have been hitting all-time highs. We've seen records even as parts of the economy are showing quite a bit of strain. Now, how would you characterize the state of the cycle that we're in right now? And would you also say that we are in this K-shape that Omar was just describing?
Yeah, there's no question that we have a lot of bifurcations in the economy, and to some degree that has translated into the market. And it's becoming a little ubiquitous to use the K, but I think it is a good descriptor, and it's at lots of different levels. Omar touched on the fact that high income versus low income asset owners versus non-asset owners in the capital spending space. You see it AI related, non-AI related. You see it within the inflation data, goods versus services. And to some degree, that has translated into market behavior. But it's interesting that the midpoint of the year, maybe the latter part of the summer, you started to see a little bit of a breakdown, at least as it relates to the market and where leadership resided. It became a little bit less concentrated. To put some numbers on that, over the past 6 months, essentially the period going back to that April period, you had only 16% of the S&P 500 constituents outperforming the index itself. That's now up to 50% over the last month. So we're starting to see a little bit of a breakdown. I think some of these bifurcations are likely to persist, probably on the consumer end, on the capital spending end, but we may be starting to see a little bit of a breakdown in those bifurcations within the equity market.
And with that K-shape in the cycle, would you also say that that translates into the markets as well? And will it continue into 2026?
So again, we had this mega cap bias. You had almost this obsessive focus on the Magnificent Seven, or the Mag 7. And I find that there still is this assumption that you can take this monolithic approach, that your ability to do well in the market is hindered unless you own in similar size some of these mega cap names. But only 2 of the Magnificent Seven are outperforming the S&P 500 this year. The number one contributor, NVIDIA, to S&P returns is only number one as a contributor by virtue of the multiplier of its cap size. It's ranked about 80th in terms of price performance, and we're seeing a bit of a pickup, so broadening out. Areas like healthcare finding some leadership, equal weight performing a little bit better relative to cap weight. And I think the 2026 environment is maybe one that's a more level playing field for active relative to passive, for equal weight relative to cap weight, and maybe even opportunities down the cap spectrum. I would though say you want to stay up in quality, particularly when going down into the small caps.
All right, so I want to talk more about the AI and the mega cap names, because a lot of this rally has been powered by this CapEx spend from these big names. And you've warned in the past in conversations that we've had about the sustainability of this and having some concerns there. That should be called into question. What does that mean for markets in 2026? And is there room now potentially for some of these AI adopters and not just AI builders to outperform?
Yeah, so one of the overarching concerns has been the circularity of financing, and it's one of the things that causes investors to harken back to the late 1990s. The terminology back then was vendor financing, but it's a circular loop of some at the core of AI, the chips makers that then invest in their customers, which in turn that sort of guarantees that loop back to those purchases. And that wasn't really a problem in the early part of the boom in AI because so much of the investment was financed out of cash flows. It was sort of an equity and balance sheet financed boom. Now, increasingly, we're seeing more debt financing. In and of itself, that doesn't suggest imminent problems. But when you see some of the action in, and I don't follow individual stocks, I'm just using it as an example, but the oracles of the world where they're really run into a little bit of trouble, it just tells you maybe that the margin of error has shifted a little bit. That said, I think some of the shift is moving away from the picks and shovels, the hyperscalers, toward who's adopting AI? How are they using it to their benefit from a cost-cutting perspective, from a productivity enhancement perspective? Is it helping in terms of labor costs? So I think those types of questions are going to be more top of mind for investors in 2026. And that suggests you have opportunities not just in the core picks and shovels, but the actual adopters and utilizers. And it'll also give us a better macro sense of the productivity associated with AI, which right now that's sort of an esoteric calculation.
And I want to talk about breadth, too, because it's been historically narrow. Only about 16% of the stocks outperformed the index over the past 6 months or so. It is starting to improve. But what would need to happen for that broadening to continue in 2026?
Well, I think the earnings backdrop is supportive of a bit of a broadening out because what you've seen is that in the last, call it 6 quarters or so, the earnings growth rate for tech, for the Mag 7, for AI baskets. There's lots of ways you can slice and dice this and find these sort of tech and AI related cohorts. Generally, you've gone from, 40, 50, 60% year over year growth rates in earnings, and those are now decelerating to a still pretty decent pace and still above the rest of the S&P 500. But the rest of the S&P 500, whether you categorize it as the other 493 or the other 490, if you're looking at the 10 largest stocks, they're actually expected to see an accelerating pace of earnings. And I think that represents a decent backdrop for stocks other than these within these monoliths. And it really ties back to something I've said about markets for my almost 40 years doing this. Better or worse often matters more than good or bad. So it's not just the level of, say, earnings growth, one subsector versus another, but it's the direction of travel. It's the rate of change. And I think that is another thing that represents a bit of a support under other parts of the market because we finally have this acceleration in earnings in many areas that have not been part of the earnings boom until recently.
So when we put together everything that we just talked about, Liz Ann, what would you say the biggest risk that investors are underestimating going into 2026 is?
Well, I think much further deterioration in the sort of the broad economy, but I would say specifically the labor market. That's been something that has sat behind certainly the decision, as we're talking today, by the Federal Reserve this week to cut interest rates. They have some concern about the labor market. You have seen a move up in the unemployment rate. You're starting to see more than just cracks in the system. I think anything much more serious that really brought back into the mix the likelihood of not just rolling recessions, which we've been talking about for many years, but an actual recession. I don't think that is built in to market expectations, obviously. It would mean probably the Fed has to get more aggressive in easing monetary policy, but I'm not sure that would be a positive elixir for the equity market. And then the other one I would say is any more serious threat to the independence of the world's most powerful central bank, which is the Federal Reserve. That's been sort of in and out of focus as a concern, but any escalation in the concern about independence in the Federal Reserve, I think that represents maybe not a high likelihood risk, but a risk nonetheless.
Lizanne, we appreciate you joining us to talk through all of that. Lizanne Saunders, Chief Investment Strategist, Schwab Center for Financial Research. Coming up, we'll take a trip abroad and break down global markets with Michelle Gibley. Can we expect international stocks to have another strong year in 2026? That and more when Schwab's Market Outlook 2026 returns. Welcome back to Schwab's Market Outlook 2026. I'm Marley Caden. International stocks significantly outperformed their U.S. counterparts in 2025, driven by lower valuations, a weaker U.S. dollar, and a rotation from U.S. tech dominance. What's in store for next year? We'll find out now. Joining us is Michelle Gibley, Director of International Equity Research and Strategy at Schwab Center for Financial Research. Michelle, great to have you with us. We saw international stocks perform really well in 2025. Do you think that performance will continue in 2026?
Yeah, international stocks could be poised for another strong year. We think global economic growth could accelerate, and international stocks are cyclically oriented, meaning that they are tied to global growth, and earnings could also accelerate. The stocks are still attractively valued, and the dollar could weaken again next year.
And we see international equities still trading at a pretty steep discount to the S&P 500. Do you think that we're finally in a growth at a reasonable price moment for global investors?
Yeah, every sector within EFA outperformed this year. Every sector except tech and communication services. And yet, despite that, every sector within EFA trades at a substantial discount to every sector in the S&P 500. In fact, 8 sectors trade at a 30% discount to the S&P. And yet we're expecting earnings for next year to accelerate. International stocks could post double-digit rates, very similar to the S&P 500. So you're getting similar growth, but at a discount. In terms of where that growth is coming from, financials and industrials are expected to have the highest rates of earnings growth, and both of those could benefit from Germany's fiscal stimulus. The defense names within industrials could benefit. Financials could benefit if economic growth accelerates. And then also healthcare stocks are expected to post solid earnings growth in Europe next year.
Yep.
So you mentioned Germany's launch of its massive stimulus program. We've also seen Europe go through one of the most aggressive rate cutting cycles in the developed world. How quickly do you expect those cuts to feed into real economic activity?
It takes time for businesses and consumers to adjust to rate cuts. In Europe, the ECB cut rates by 235 basis points from June of 2024 to June of 25. That's among the largest and fastest rate cutting cycle in the developed world. We're starting to maybe see the benefits. In the chart, bank lending is accelerating, and that can result in more economic activity when those funds are spent. And you mentioned Germany's fiscal stimulus. They announced €1 trillion of stimulus to be spent over the next 10 years, equally on defense and infrastructure. And that's just getting started. Germany was operating under an emergency budget for 2025, and they've passed the 2026 budget through one house of parliament and the other votes December 19th. So we could start to see some of that spending underway as the year begins.
Talked about emerging markets in the past and how they offer a different pathway to potentially participate in this global AI growth story. Where do you see the most opportunity, Michelle? And also, are there some opportunities for emerging markets to benefit even if we see U.S. AI CapEx spending cool down some?
Yeah, we saw this DeepSeek moment at the beginning of the year that really was a wake-up call for people that Chinese companies can innovate. And really, that's been the case for a long time, but it really took that moment to get attention to it. So Chinese stocks have benefited from that optimism about AI innovation and adoption. And there's also some large names within the EM index that are based in Taiwan and Korea as well. Now, China does have the benefit of plentiful low-cost electricity, which is a key AI input. And so that could help them even if we get some concerns about AI CapEx potential for slowing in the U.S. Now, earnings for EM stocks is expected to accelerate next year. Their valuations are not yet extended, so they could have another good year next year. They would also benefit from a weaker dollar. Now, EM, we think deserves a small place in investor portfolios, but I would caution that the more EM acts like a tech stock, the less potential diversification benefit it may have for U.S. investors.
And for our last question, let's specifically talk about China here. You mentioned the cheap electricity. We have improving sentiment after we've had some developments in this trade truce here, and valuations are still depressed. Do you think that China deserves a second look from investors in 26?
It's amazing what a year can do. Last year all we heard was China is uninvestable. And if we looked at the MSCI China index last year, it was trading at 9 times next 12 months earnings. So very cheap. It's 12.5 times now. So we've had a little bit of that valuation discount narrow, but it's still inexpensive compared to other markets around the world. And as I mentioned, China's been innovating for a long time. They've been filing more patents per year than the US for over a decade. Now, I would say, though, in the past, China's government has subsidized certain industries or encouraged so much investment that it resulted in excess supply, and that has put downward pressure on prices and margins. So that's a cautionary tale for investors. Typically in the U.S., valuations here have benefited from the rule of law, strong bankruptcy protections, more transparency for public companies and economic data, and less government interference. But we still have this AI CapEx race, and investors' perceptions about China and U.S. are still evolving.
Michelle, it's always a pleasure to speak with you. Thank you for taking the time tonight. That's Michelle Givley, the Director of International Equity Research and Strategy at the Schwab Center for Financial Research. Coming up, it's time for us to talk fixed income. What's in store for bonds, yields, and credit spreads next year? Kathy Jones and Colin Martin from the Schwab Center for Financial Research join us next. Welcome back to Schwab's Market Outlook 2026. It's time to talk fixed income. And who better to break down bonds than Kathy Jones, Chief Fixed Income Strategist from the Schwab Center for Financial Research. Kathy, thank you for being with us. We saw bonds have a really strong year this year. Do you expect that to continue in 2026, or should investors expect some moderation?
I think moderation is the reasonable expectation. We had a very good year in 2025 for fixed income. Every asset class or sub-asset class that we track has produced positive returns. International developed market bonds posted returns, double-digit returns year to date. Partly that was due to the drop in the dollar. So the dollar was down about 8 to 10% on a trade-weighted basis, and that helped to lift the returns to investors in international. But every category posted positive returns. And I would say, we look at a benchmark such as the Bloomberg Aggregate Bond Index. That's up, nearly 7% year to date. Now, a lot of that has to do with the fact that we had a high starting yield, so the coupon payment makes up a big portion of your total return. And then we had some Fed rate cuts, some moderation in overall yields, and that helped boost it. I think going into 2026, we're probably looking at still positive returns because the coupon yields are still pretty attractive, although not as high as the starting yields in 2025. So that will probably mean less robust returns, but still mostly positive as far as we can see. We still have a Fed bias towards easing. The hope is for inflation to come down. And again, the coupon return is pretty attractive.
And Kathy, you mentioned the Fed rate cuts there, and we did get this 25 basis point cut, but we're now debating how much the Fed is going to cut in 2026. Where do you see the Fed funds rate landing by the end of 2026? And what are the biggest factors do you think that could limit, or accelerate the cutting cycle?
Yeah, so what we heard from Fed Chair Powell at the recent meeting was that the Fed believes that they're getting close to the neutral rate, and that neutral rate is somewhere between 3 and 3.5%. So the lower bound of the Fed funds rate right now is 3.5%. So kind of at the upper end of that so-called neutral rate. And for people who aren't familiar with the terminology, neutral simply means the rate that is neither pushes the economy higher or lower, doesn't boost inflation, doesn't boost unemployment. So it's kind of the sweet spot for policy rate. So I think that there's not much room left for the Fed to ease unless we get significantly lower inflation. So far, inflation's been pretty sticky. It's holding close to 3%. It really needs to come down closer to the 2% target for the Fed to feel comfortable cutting rates. So we're only looking at maybe one more rate cut, 1 to 2 more rate cuts possibly in 2026, and that could limit some of the total return in the bond market, not getting that boost from Fed easing.
And one of the big conversations on the bond desk right now, of course, is curve steepening. And do you expect long-term yields to stay elevated even if the Fed does trim short-term rates those 1 or 2 times that you just mentioned?
Yeah, we do. And the reason is that the longer-term rates are influenced by Fed policy, but they're also driven by expectations for inflation, economic growth, and risk, and supply and demand. So the term premium, which is that sort of extra yield that investors demand to buy longer term bonds versus holding short term bonds, has moved higher in the last year or so. And we think that that trend will continue. As you can see, it's moved from negative territory to positive territory, but it's really still below the long-term sort of average. And I think that as we go forward, there's a good chance that that term premium will increase, and that'll keep long-term rates elevated relative to short-term rates. So even as the Fed's cutting, we may not see 10-year yields, for instance, move much below 4% because we have still high and sticky inflation. We have the prospects of high and rising fiscal deficits. We have a lot of issuance coming from the corporate bond sector as well. So there's a lot of supply to be absorbed by the market. And in order for that to be absorbed, probably those yields are going to have to stay up relative to short-term yields to attract those buyers. So we are looking for a continued steepening of the yield curve and for 10-year yields, 20-year yields, 30-year to stay elevated.
And Kathy, I want to bring Colin Martin into the conversation. Joining us now, Colin Martin, Chief Fixed Income Strategist at Schwab Center for Financial Research. Colin, great to have you with us. I'm not sure how much of that you just caught. We were talking about the steepening of the yield curve and the 10-year. It's had some trouble breaking below 4%. Kathy saying she doesn't anticipate that because of sticky inflation, also the term premium numbers that we're looking at. So my question for you is, how should investors think about positioning? Where is the sweet spot now for them?
Yeah, we think the sweet spot is the intermediate term part of the yield curve. So there's dual risks right now. There's reinvestment risk if you focus too short, and there's more interest rate risk if you focus too long. So all the points Kathy made about sticky inflation, the term premium, things that can at least keep long-term yields elevated and maybe pick them up a little bit, that means that there's some risk there for the prices and values of long-term bonds. Now, on the short end of the curve, I mentioned reinvestment risk. If the Fed gradually cuts rates as we expect, even if it's just 1 or 2 more times, that does mean the income earned on shorter term investments should continue to fall. So we kind of like the sweet spot as intermediate term. That usually means average maturity, say in the 4 to 10-year range. One way to get exposure like that is to just look at the U.S. aggregate index. It has an average duration of around 6, but we think it's a nice way to get, attractive yields for longer than being, opening yourself up to reinvestment risk without taking too much interest rate risk in case there is some interest rate volatility next year.
And Colin, staying with you here, for investors who want safety but also yield, is the case for Treasury still compelling next year, even though Kathy says that we should expect some moderation in terms of returns?
Yeah, we still like treasuries a lot. We like high quality investments, and that can mean a number of things. It usually includes on the taxable side, the investment grade rated parts of the market that generally make up the U.S. aggregate index. So that's U.S. treasuries, agency mortgage-backed securities, investment grade corporate bonds, and on the taxable side, or the tax exempt side, that would include municipal bonds as well. We like the up in quality theme mainly because investors aren't just being rewarded too well to take on additional risk. So as we look to 2026 and total return expectations, when we look at the riskier parts of the market, maybe there's some price appreciation there, just as we might expect with treasuries. But if there is a moderation in the economy and we start to see some credit losses, maybe we don't see that as strong of a price appreciation. On the high quality side of the equation, let's focus on investment grade corporate bonds. It's really an area I focus on. We've been talking about how attractive they've been for a couple of years now. One, their credit quality is relatively strong. We're seeing improving fundamentals. Corporate profits are near all-time highs. So companies, especially high quality, highly rated companies, have the ability to remain current on their interest payments and their debts as they come due, and the yields are attractive. We just showed a slide that shows the slope of the investment grade corporate bond yield curve, and you're actually rewarded with slightly higher yields as you extend out to more intermediate term maturities. So again, we think it's a nice balance of risk and reward with intermediate term investment grade corporate bonds. We can get yields in the 4.25 to 5.25 area.
And Kathy, coming back to you, Colin also mentioned munis there. So let's talk about those. They've been a quiet winner in fixed income. How healthy is muni credit heading into 2026? And where along the curve are you seeing the most attractive opportunities?
The municipal bond market actually didn't perform as strongly as other parts of the market, but that's because issuance was really high this year. So there was a lot to absorb. But credit quality in the municipal bond market, investment grade is very, very solid, very high. And the risk of default has historically been very, very low in that market. We do see some added value if you go out in duration a little bit further on the curve. You tend to get a steeper slope of the yield curve out there, and that does allow you to get extra yield while maintaining high credit quality. So if you're looking to add duration to a portfolio, especially if you're in a higher tax bracket, it might make sense to use any extension of duration. You might be wise to use the municipal bond market for that because credit quality is quite high.
I want to thank you both for that deep dive into the bond market. Kathy Jones, Chief Fixed Income Strategist at the Schwab Center for Financial Research, and Colin Martin, Head of Fixed Income Research and Strategy, also at Schwab Center for Financial Research. Coming up, what can traders expect for markets in 2026? Joe Mazzola will join us to answer that question and more when the Schwab Market Outlook 2026 returns. Welcome back to Schwab's Market Outlook 2026. I'm Marley Caden. Joining us now in studio here, Joe Mazzola, the head of trading and derivatives strategist at Charles Schwab. Joe, great to have you with us in studio. Heading into 2026, you described the market as standing on solid ground. Can you walk us through what's supporting this outlook for you?
I mean, part of it is just the movement that we've seen in the last couple of months, the distribution that we've seen moving into, financials leading, a lot of the cyclicals leading, discretionary is now picked up. So we've moved beyond this this focus on AI. And what's really interesting is you can actually have some of the AI names underperforming. I know you and Liz Ann talked about that a little bit, and you can still get the market moving in the right direction. Now, that being said, I think we're probably in a little bit of a consolidation phase right now, but I think that's healthy. I think, kind of given the move that the market's had and given the PE that is trading at around a 22 PE, for us to be able to continue to find support at these levels, coming up a pretty solid earnings period is healthy for this market.
And we're still seeing valuations above historical averages. What makes you confident that the market can sustain the gains that we've seen, particularly outside of tech and communication, as we are starting to see some rotation and some pullback?
Sure. Well, I think if you look at expectations for 2026, tech is leading the way, and communication services are leading the way in terms of expectations for earnings growth. But if you look at something like materials, if you look at something like financials and healthcare, they're looking at double digits year-over-year earnings growth as well too. So if we can have some stability there, and I think another key is this, Marley. You were just talking about, or just talking fixed income. What we've seen is we've seen a lot of stability within the 10-year yield. It's been trading within a range. I think stability in the bond market will lead to stability in the equity market, and that can carry us forward. Now, if we continue to see the earnings growth at a similar clip, maybe it's not the 13, 14% we've seen in the last couple quarters, but something along those lines, the market can continue to power ahead.
And we are starting to see some of this leadership broaden. I had this conversation a little bit with Lizanne about the broadening and where we might think about it. As traders are starting to think about sector rotation, especially with some of the ones you highlighted, healthcare, industrials, financials, how do you think about rotation when you're investing as those are stepping into the spotlight? But we certainly know that tech is going to remain a big story here.
So I think the way to look at it from a trader perspective is you look at something like market breadth. Or where are you seeing the relative strength? Where do you see the money flowing into? We're really starting to see, once again, that outperformance. Healthcare has been leading the way the last couple of weeks. Financials really started to break out this time within the last week or two. Part of that, I think, has to do with the steepening of the yield curve trade that we've been seeing. But it's not just the S&P 500. Just brought a chart up there looking at percentages of stocks above their 200-day moving average. Russell has really shown some strength. So you're seeing the small caps break out. Once again, I think that's part due to the belief or the Fed rate cut that we just saw. But the belief for 2026 that we're going to get multiple cuts, I think that's where that's probably a little overly optimistic. I think there's probably one, maybe two priced in if you look at the summary of economic projections that just came out on Wednesday. So I think what you have to kind of pay attention to as you're looking for those sector rotations is say, okay, which of these are economically sensitive? Which of these can outperform from an earnings standpoint without getting an additional push from the Fed? That's why, even though we've had this Russell 2000 break out of the small caps, I still kind of wonder, is this the same kind of song and dance we've seen in the last couple of years, where you get that momentum in the small caps and they pull back? Until I see otherwise, I'm probably going to err on the side of caution and still look towards kind of technology and some of the other sectors to outperform.
I want to talk about market breadth here and dive a little bit more into the technicals here. We've seen it improving. You mentioned the Russell. I think more than 60% of the Russell members are above their 200-day moving average right now. How important is breadth when you're trying to confirm trends? And then how does it affect derivative strategies?
Good question. So breadth, basically, think of breadth as this. Lifting the tides, right? So the more tide you have, the more participants, the better that sector can do. And that way you don't have such narrow leadership. Narrow leadership, as we've seen for the last couple of years, you can have a market that continues to go up on narrow leadership. What happens, though, is it becomes susceptible to changes in catalysts, right? If there's some type of catalyst that comes along that kind of knocks the market out, well, you have less support for the overall market as a whole. What we're seeing right now with this additional broadening, it's not to the point where I would say that there's a market thrust or breadth thrust, but it is supportive, and I think that's the key. I think the market's really trying to figure out right now what that catalyst is for 2026. I still think it's probably earnings, but from a derivative standpoint, here's one of the things that I think is I've seen in the last couple of weeks that I think is pretty important. We talk about the difference between institutional and retail trading. So if you're looking at kind of what institutions are doing, I think it's important to look at something like the SPX. So the SPX is the S&P 500 options. And when you start to see a lot of hedging in that product, that tends to be driven by institutional traders, just because a lot of retail traders aren't trading products that are that large. What we've seen over the last, basically since the Fed meeting and even a little bit preceding that, is you started to see a lot of the hedgers come out of the market. You're not seeing the same amount of trading for people protecting against downside, and I think that is constructive. On the retail side, what you continue to see is this buy the dip mentality. It's carried forward really all year, and it really is the retail crowd. And I stress this because I think it's important. It was the retail crowd that bought the April April bottom that really kind of took off the market. They bought the bottom that we saw at the end of November, and they're continuing to do so. So as long as I continue to see that participation, I'm going to feel pretty constructive.
So for traders who are focused on derivatives, which sectors or market conditions in 2026 do you see as offering the most attractive opportunities for options or spreads or other strategies?
So let's talk about kind of just strategies as a whole. I think if you're concerned about valuations and you're saying, well, I don't know if I want to buy the stock, there's great ways to trade like debit spreads or stock replacement strategies where you buy a slightly in the money call option, then you sell a call option as a way to help finance that. I think those are great ways to participate in the market, especially for people that don't want to that are looking not only at high PE ratios, but nominal prices, right? I mean, if you look at the top stocks in the market right now, or the top performers year to date, a SanDisk, well, that stock for a lot of people, buying 100 shares of SanDisk is a really high debit to their account. So they can participate in different type of debit cred strategies. A Micron, these are the stocks that are the top 5 or 6 stocks in terms of year-to-date performance. People think it's the Mag 7. But there's only one of the stocks in the Mag 7 that's in the top 25 year-to-date performance. So I think it's important to think about other creative ways, and the options market offers those opportunities.
Well, great insight there. Great to have you in person as well, Joe. Thank you for being with us here in studio. We really appreciate it. That's Joe Mazzola, the head of trading and derivative strategist at Charles Schwab. Coming up, it's time for our lightning round. Our Schwab panel of experts weighs in on a variety of topics when Schwab's Market Outlook 2026 returns. Welcome back to Schwab's 2026 Market Outlook. I'm Marley Caden. It's time now for our lightning round with our panel of experts. We'll have Joe Mazzola, who's here in studio with me, kick things off. Joe, question 1. Is the Mag 7 going to carry the mantle into 2026?
Ooh, good question. Well, I'm not positive that it carried the mantle into 2025. So, I think there's going to be dispersion in the markets, and I think there'll be dispersion within the Mag 7. So I think it's possible that a couple of them do, but I don't know if all 7 are, finish in the top 100. We'll see.
All right, Liz Ann, next one's for you. Are we in an AI bubble?
Probably, but this could be 1997 and not 1999. I remember a Warren Buffett quote from early during the dot-com era where he was talking about the confidence of investors that were sort of dancing at the ball with Cinderella, all feeling very confident that they would get out just before midnight. And his punchline to the line was, the problem was the clocks had no hands. The point is that you don't have to try to time some exact moment of a popping of a bubble. Think about bubbles as about asymmetry, where you start to see limited upside, but more potential downside. And you manage that through diversification, through reasonable time horizon, through mindfulness around concentration, periodic rebalancing, AKA profit taking, and widen the net. To Joe's point, what we talked about earlier, Marley, I think the opportunities even tied to AI are broader than they were in a year like last year and the year before.
All right, Michelle, next one's coming to you. Excessive regulation in Europe, does it slow down growth or not?
Regulation has certainly pulled down Europe's growth. Despite the euro being a currency union, the capital markets are not a union. So there's a separate stock market for each country with different filing requirements, different regulations. And can you imagine if we had a separate stock market for every U.S. state? This lack of a capital markets union reduces the ability of startups to raise money. It also hinders R&D. Former ECB President Mario Draghi, also former Prime Minister of Italy, he laid out a year ago 383 recommendations for Europe to improve its competitiveness. Now, you might say that's bad news, but the good news is that it shows there's a lot of opportunity to improve. Investor expectations are low, and as Lizanne said earlier tonight, better or worse matters more than good or bad. If we just get things a little bit better, that could boost European stocks.
All right, Colin, next one's to you. Should we be concerned about credit cockroaches? Are we due for an infestation?
I don't think we're due for an infestation. The credit cockroach idea stemmed from comments from JP Morgan CEO Jamie Dimon when there were some high-level defaults back in September and October, with the idea that there might be a lot more coming. And we don't necessarily think that's the case. I think for starters, Defaults have been happening for the past few years. We just haven't really been hearing about it because a lot of the defaults lately have been distressed exchanges where issuers kind of renegotiate the terms of their debt with their lenders. And that technically constitutes a default because often there involves some sort of credit loss. We don't think this is going to be widespread, though, but it's enough that makes us a little bit cautious, and it ties into our view about our up in quality theme and really why we prefer investment grade corporate bonds. Because if you look at high yield bonds, yes, the yields are relatively high, but when you factor in some sort of potential credit loss, that reduces the outlook for the potential total returns. So why we're focusing more on high yield bonds in moderation as opposed to being a tactical overweight, but we're not necessarily concerned that we'll see this flood of defaults and bankruptcies in 2026.
And Joe, we didn't really talk much about small caps here. So what's your outlook for small caps in 2026?
Can I break it up into profitable versus non-profitable small caps? Because I think there's room to run for the profitable small caps. Given from the chart perspective, we finally got a breakout. Not only was it this a year to date, but it's an all-time breakout. And when you look at the potential for some of these companies, specifically the ones that are actually making money, look, there's a good percentage of regional banks that make up the Russell 2000. I think that they're positioned to do well. I think the overall financial sector is positioned to do well. And I think there's some opportunity within biotech, within some of the small caps that is positioned to do well in addition. So, like I said, if you break out the profitable versus non-profitable, I think there's opportunity.
And Colin, the last question's coming to you. We didn't talk about tips. What is your outlook for Treasury inflation protected securities?
Yeah, we like tips a lot, Marley. We talked earlier in our outlook about the idea that inflation's still sticky right now, and that can be a benefit for tips. If you're not familiar with what Treasury inflation protected securities are, they're traditional treasuries, but their principal values are indexed to the consumer price index. So as the rate of inflation rises, so too does their principal value. We really like tips for two reasons right now. First are the positive real yields they offer. So you can get tips with yields of somewhere between 1% and 2%, but those are already inflation adjusted. So if you hold that tips to maturity, you'll generally outperform inflation by that amount. So it's a good way to pretty much lock in a positive real rate of return as long as you're holding it to maturity. We also look at something called the break-even rate. It's the difference between the tips yield and the yield on a traditional nominal treasury. It's basically it's a hurdle rate for outperformance. It's what would inflation need to average over the life of the tips for the tips to generally outperform the nominal treasury. Right now, those break-even rates are in the 2.3 to 2.4% area, but inflation's still close to 3. So if inflation does remain sticky, we think that break-even rate's a little bit too low. So it means there's more potential outperformance for tips over the short run.
I want to thank all of you for being with us for our lightning round. Joe Mazzola, Colin Martin, Michelle Gibley, and Liz Ann Saunders. We appreciate it. That is going to do it for our Market Outlook 2026. Thank you to our entire Schwab team for their contributions. I'm Marley Caden. Thank you all for joining us. Have a great night.